Today in this video, we're going to talk about which mortgage loans are the best for you when you have student loan debt, a lot of student loan debt. Check it out. Hi, I'm Rhonda Burgess, and I'm a real estate broker here in Nashville, Tennessee area, and I'm also a mortgage underwriter. In this video, I want to go over a lot of misconceptions that are going around and just bad information that's being put out about which loans should you do if you have student loans, if you have a lot of student loan debt. I did a video last week where I said, a reason why a lot of people are getting turned down is simply because the originator or the loan officer just doesn't know. They just don't know what they're doing, or they're trying to put you in a loan where you don't fit. So let's talk about this. I know a lot of times the loan originators will try to put you in a FHA loan because FHA is the most popular. It's the one that they're most familiar with. But FHA may not, and oftentimes is not the best loan for you, especially when you have student loan debt. Regardless of whatever repayment plan you're on with FHA, and if it's one of the income-based, income contingent, pay as you earn, whatever, where your payment is smaller. It may even be zero, okay? Because it is based on the income that you have reported from your income tax return. So a lot of times your payment may be reporting as zero, and that is the payment, or it may be $5 or it may be $11 or whatever. But that payment, that low payment, will not pay off your loan. It will not, it's not a fully amortized payment, so it will not fully pay off your loan, okay? So when you're doing an FHA loan, FHA is going to count 1% of your student loan balance as your payment. Even though your payment says $0 or $10 or whatever, it's going to take 1%. So if you have $100,000 in student loans, that's $1,000 a month. That's what they're counting that payment as. If you have $50,000, they're counting that payment as $500. If you have $200,000, they're counting that payment as $2,000. No, you're not making a $2,000 payment every month. We know that, but that's what FHA guidelines call for. So in order to get around that, because that's blowing a lot of y'all out the water, because you're calling me all the time and they're like, well, my DTI is still out of whack. You put in the work. You have, for the last 2 years, you haven't been writing off all your money. Like I told you in the last video, you've got your debt to income together now. Okay. You've gotten rid of these expensive car notes, these $1,400, $1,500 car notes. You've gotten your stuff together, but they're telling you that your student loans are still blowing you out the water. That's because you're on the wrong plan. You're on the wrong loan. What you need to do, there are two other loans. Really, there are three, but I'm going to talk about two other loans that will work much, much, much better for you. Okay. The first one, you need to be in a Freddie Mac loan. We have Fannie Mae, we have Freddie Mac. All you student loan borrowers, y'all know Sally Mae, they all cousins, brothers, sisters, and them, okay? Fannie Mae is the biggest backer of loans, meaning it's not a government entity, but it acts like one, okay? Fannie Mae is the big sister. Freddie Mac's the little brother, okay? Little brother Fannie Mac. Freddie Mac. So what you need to do is you need to talk to, when you're talking to someone about getting a loan, ask them, are you familiar with Freddie Mac products? A Freddie Mac loan? Because let me tell you the difference. Freddie Mac will only count 0.5% on those same student loans. So just like I explained, instead of your payment being $1,000, they're only on $100,000 of student loans, they're only going to count $500 as your payment. Do you see how much more room you got in your DTI to make this work? Okay, you need to look at a Freddie Mac product, a Freddie Mac loan. They have a little different underwriting system. Everybody uses the desktop underwriter, the DU. They have Loan Prospector, the LP. You just need to find someone who is familiar with the Freddie Mac products to be able to run your loan through the underwriting model and see if they can get you accepted with just a half of 1% instead of the full 1% that FHA uses. The second type of loan that will work for you much better and only counts 1/2 of 1% of your loans is a USDA loan or the rural housing loans. Yes, I'm an underwriter for USDA. I'm not pushing USDA for any other reasons other than, hey, we only count 1/2 of 1%. We don't count 1% like FHA. You know, you've got to, when you have a lot of student loan debt, you got to find other ways to work around this. Okay, you got to find other ways. Now, true, USDA, we are more in your rural communities. We're in the rural communities. But just like I told y'all in the video last week about buying in this seller's market, you're going to have to look outside. You can, the city, those houses right there in the city, they blowing you out the water because number one, they're going for way above list price anyway. So you need to expand your area. And when you have a lot of student loan debt, don't get me wrong, I understand you want what you want. But sometimes you got to detour a little bit and you may have to start out here in the country a little bit just so you can get in and start building that equity. Then there's nothing that says that you can't sell in a couple of years and get you a house closer in town or wherever you need to be. But sometimes you got to back up and look at the situation and say, well, let me get in where I fit in right now. You know, you may be close to getting student loan forgiveness in another 2-3 years where your student loans will be forgiven, or you're a teacher and you're in one of these other programs that do the student loan forgiveness or whatever. And you're just 3, 4, 5 years away from getting your student loans completely forgiven. But you want to buy a house. Sometimes you got to go where you fit in, and then you can come back and and look at the situation again. But another reason why the USDA is such a good loan, it's 100%. You don't need 3.5% down. You don't need 10% down. You don't need 20% down that you would normally need when you have a lot of student loan debts. You can get, the USDA is 100% loan. Now, I'm not saying that you may not have to put money down to make your DTI work. But what I'm saying to you is, if you've done the homework and you know the only thing that's blowing you out the water is your student loans, then you may really want to consider a USDA loan, a rural housing loan, where it's 100%. You could use that money that you saved up to pay your own closing costs, because 9 times out of 10, that's what you're going to have to do in this market right now. But they'll only use 1/2 of 1% to make your ratios work. Now, and another thing, there's a lot of misconceptions about what's rural in USDA. I'm going to put a link down below to the USDA maps, and where you can go in and you can put in an address of a house that you're looking at or an area that you're looking at, and you will see if it's eligible for USDA rural housing loans. If it is, then that's the way you need to run. And again, you need to ask your loan originator, are they familiar with doing a USDA loan? Another good reason why you should want to consider USDA is because we call it a fee, our guarantee fee, right? But our fee per month is usually cheaper than the PMI, the private mortgage insurance on an FHA loan anyway. So it's a lot of win-wins you can have if you consider a USDA loan, and again, like I said, a Freddie Mac loan to help you get around your high student loan balance. Please consider subscribing to the channel if any of this information has helped you, and share the video with someone who may need this same help. Thank you. And you know, from previous videos, I've told you, you got to have a very good credit score. You need a good credit score. Because the higher your credit score, the more play you're going to have in that DTI. A lot of loans, a lot of mortgage loans, when you may need a higher than normal DTI, maybe you need a 45% DTI to work, to make your stuff work, or you need a 46 or something like that. The scoring models, a lot of times, if you have a high credit score, they will allow you a little bit more leeway so that you can have a higher debt to income on the back. This goes for any loan, Freddie Mac, Fannie Mae, USDA, whatever you're doing. But you need to make sure that your credit score is strong when you have a lot of student loans. Again, my name is Rhonda Burgess, and I'm a real estate broker and mortgage underwriter here in Nashville, Tennessee. If you need my help, I would be glad to help you. If you need help with finding someone who is familiar with the Freddie Mac or the USDA products, you can feel free to give me a call or text. My number is 615-554-0832. Again, thank you as always, and have a blessed day.